President Kaplan, I know this sounds weird, but where's your dot? Are you a 2022 guy in terms of raising rates?
There were some dots starting increases in 2022, and you know, I'm at one of those dots. Yes.
Fascinating. And let me ask you about removing accommodation. And Joe, I'm sorry if you wanted to follow up, but I'll just get this one out there.
I feel like I stole your stuff already, but when I get you to say $3 trillion, it's got $3 trillion. That sounds after 1.9. We're like desensitized, President Kaplan. I think you need to talk to your colleagues, and you still got a relationship with Chair Yellen, Secretary Yellen.
So we'll have to work our way through 21, 22, and 23. I think that it's worth remembering we're still in the midst of the pandemic right now, and we still got to move beyond the pandemic and not take that for granted. But again, I would say as we do, and as we meet the first test of substantial further progress toward our dual mandate goals, I'll be an advocate of removing some of this extraordinary accommodation, starting with bond purchases. We're just not there yet. It's an outcome-based test. Our tests for raising the Fed funds rate years in the future is an outcome-based test. And I'm going to be on my front foot watching how the economy unfolds and being prepared to act as the economy meets those benchmarks.
Might that be this year, President Kaplan?
I'm going to stay away, as you know, Steve, from calendar estimates. Our benchmarks are not calendar-based, they're outcome-based. And so I'm not going to prejudge when we're going to make substantial further progress. But as I see that test being met in my own mind, I'll be arguing for taking action. But I don't want to predict exactly when in the calendar that will be, because truth is, I don't know.
Let me turn to another aspect of Fed policy here, which is whether the Fed ought to come in and play a role in suppressing the yields on the long end in the bond market. Are you an advocate of that? Is that something the Fed should do? And did the Fed somehow give the markets the idea that that's what it would do at a certain level? Was that a mistake the Fed made in communication?
It would not be something that I would support unless there are some extraordinary circumstances. I would not be an advocate of using monetary policies to do more to distort the pricing of the Treasury curve. I would not do that. There might be circumstances that I would be open-minded to, but my baseline view is I would not do that. And I would just also emphasize, I've been one that's been saying for most of this year, I would expect the 10-year to back up further from here. And that means 1 3/4, 2%. In February of 2020, the 10-year Treasury was 1 3/4 to 2%. I don't see why, as we recover, that the 10-year rate won't back up further. I think that'll be a healthy signal, not an alarming signal, but a healthy signal, and not one that I would be an advocate of getting in the way of.
Shepard Smith here. Thanks for watching CNBC on YouTube.